Hi everyone, my name is Deepak Best. Welcome back to the channel. Today we will be starting with valuation question and answers. Previously we have discussed the basics and the advanced questions on enterprise value and equity value. And now we are starting with valuations. So all the very best learning. Without wasting any time, let's get started. So let's start with question number one. Here in the question, it's been asked that the three valuation methodologies. And the answer to the answer to this question is comparable companies precedence analysis and DCF, popularly known as discounted cash flow. So comparable companies analysis, precedent transaction analysis, and discounted cash flow analysis. This is a classic investment banking and finance interview question. It tests your understanding of how to value a company. That is how you determine what a company is worth. So first of all, let's understand what valuation is. So valuation is actually understanding or estimating the economic value of a business or asset. And valuing or valuation is important it's important when we are merging or acquiring a company, when we are uh, when we are actually doing an investment analysis, or we are doing a IPO, initial public offering, or in day-to-day life, corporate financing decisions when we are raising capital or selling a division, or when we are dissolving a division, or we are demerging. So valuation methodologies or valuation comes into play. So let's talk a little about comparable company analysis. So comparable company analysis, this method actually values a company by comparing it to its similarly publicly traded companies, that is the peers in the same industry and similar characteristics. The logic behind is that if similar companies trade at a certain multiple, our company should also trade at the same range. So we are comparing in between our peers. So the steps which are involved in comparable company analysis is first selecting the peers, like I've told you. So the peers are selected on the basis of industry, size, growth rate, geography, and profit margins. Then we start collecting the data of the peers, like market capital, enterprise value, revenue, EBITDA, and net income numbers. And then we calculate in the third step the enterprise value to the EBITDA ratio, enterprise value to revenue ratio, and price to earning ratio. So the three ratios which comes under comparable companies analysis are enterprise value to EBITDA ratio, enterprise value to revenue ratio, and price to earnings ratio. And the second methodology is precedent transaction analysis. This method looks at past merger and acquisition transactions involving similar companies, what prices investors paid in real deals. And the logic behind is that if somebody pays 12 times of EBITDA for a similar company recently, our company should be worth around that only. So, so let's assume that there is a company A, and somebody paid $100 million for that company, and I'm assuming that EBITDA numbers are $10 million. So this means that 12 times or 10 times of EBITDA is being paid. So if somebody else is in the same business model, or they have they are peers of that company, so they will start valuing their company on the precedent transaction analysis, that if the other company is being valued at that price, we our valuation also gets updated. And just like comparable companies analysis, precedent transaction also involves enterprise to EBITDA value, enterprise to EBITDA ratios, and enterprise to revenue ratios. So the steps involved in calculating precedent transactions are in identifying the comparable transaction in between same industry, region, size, and business models. Then gathering the transaction data like purchase prices, targets, financials, and then calculating the ratios, enterprise value to EBITDA, enterprise value to revenue, and then applying the median multiples to the targets metrics. So precedent transaction often produce higher value multiples than public comps because buyer pays a control premium, extra price for full ownership in precedent transactions. And deal often includes synergy value also. So these are the few notes which you need to keep in mind that the buyer actually pays a control premium, which is extra premium for full ownership in precedent transactions. And deals often include synergy values. So let's talk about the third type of valuation methodology, discounted cash flow. So the DCF values a company based on the present value of future cash flows. So if a company do not have any cash flow, then you cannot apply discounted cash flow in that company. So this eliminates the possibility of using this method if the company do not have any cash flows. So the logic is that a company is worth the sum of all the money it will generate in future to discount it back to today's value. And the steps involved in a DCF are to project free cash flow first for 5 to 10 years. Then we calculate the terminal value, value beyond the forecast period after 5 to 10 years. And we are assuming that the company will be valued on a going concern. We are not estimating that after 5 to 10 years the company will stop. So we calculate a terminal value, perpetuity and annuity. Uh, there, those formulas are used. Then we discount all the cash flows to the with the discount rate. We calculate the discount rate on the basis of weighted average cost of capital. Then we add all these discounted value to get an enterprise value. So enterprise value is calculated for a DCF in a different way. We add up the cash flows. And previously we have discussed about enterprise value in detail. If you missed those lectures, please go and watch those lectures. We have discussed about the enterprise value, the practical way and the theoretical way in detail there. And there are some pros and cons involved with every method. So let's just discuss a little about these pros and cons. Let me just share you my whiteboard. I hope this is visible. So the I have created a table based on what the method is based on and are the pros and what are the cons. So comparable company analysis actually is based on market trading multiples, enterprise value to EBITDA, enterprise value to uh, revenue, price to earnings. Now trading multiples of the company, trading multiples in the market. So the pros are that it's quick, reflects market sentiment, and the cons are the negative sides or the downsides are that they may not capture company specific differences. If we are using precedent transaction analysis will be based on M&A deal values, and it will reflect real buyer prices. But the downside is that data can be limited and includes premiums also. And when we are using a DCF, the future company's cash flow potential, it is based on future company's future cash flow potential. And the pros are theoretically sound, company specific, but the cons are that very sensitive to the assumptions, growth rate, discount rate. So if you are assuming that the company will be growing at a rate, but the economy and the products are not growing at that rate, at that similar rate, what the other peers are growing at a rate of, and the discount rates also, because inflation causes rates to go up or down. And economically, these estimating these growth rates, so forecasting something in the future, it's like looking into the future, and future is very uncertain. So I hope this makes sense. And this was just the first question of the reading, and we will discuss about these questions in detail in the further questions. So let's move to question number two and see, okay, what the question two is asking about. The question number two is about ranking the three valuation methodologies, and let's break it down carefully, step by step. The three core value methodologies are comparable company analysis, which and precedent transaction analysis, and DCF. We have discussed about it previously in the question number one. The interviewer is asking you to rank them in terms of values they typically produce. And the trick is that there is no fixed ranking that always hold true, because valuations depend on market condition, deal dynamics, and assumptions. And however, there are general tendencies you can explain, like comparable companies analysis or comps, s- uh, popularly known as comps. And what it is comp values a company based on how similar publicly traded companies are being valued in the market using multiples like EV, EBITDA, price to earnings, and enterprise value to revenue numbers. And the characteristics of comparable companies is that it reflects current market sentiment, usually lower than acquisition value, because buyer pays a premium to gain control, and changes daily with the stock market. If we talk about precedent analysis, precedent transaction, so it looks up the past data of similar companies and their multiples paid to in those deals. And why it's usually higher than comps it, because there is a control premium. Buyer pays extra 10 to 30% to acquire control in precedent transactions. And this is used basically in merger and acquisitions. Synergies, acquirers expect cost savings or revenue growth, so they can afford to pay more. So typically, precedent transaction analysis numbers are more than comparable company analysis numbers. This will result in a bigger number than the comparable companies analysis. And discounted cash flow, if you talk about discounted cash flow values a company by forecasting its future cash flows and discounting them to present value using a discount rate, which is weighted average cost of capital. We will discuss about WACC in the later on readings. And the enterprise value is calculated by present value of future cash flows, the future cash flows plus the terminal value. Why it's variable? Uh, the DCF is highly sensitive to assumption I mean, DCF is very sensitive to assumptions about growth rates, margins, discount rates, and terminal values. So it can produce either the highest or the lowest value depending on how optimistic or conservative you are. If you are very much optimistic, your growth rate, margin, discount rates will go up, and your terminal value also. But if you are conservative, then you will always look at the worst case scenario. So in DCF, we make scenarios also. So base case, worst case, and the best case. And in short, if we talk about it, there is no ranking, fixed ranking, but usually precedent transaction numbers are higher than comparable companies' numbers, and DCF numbers can be variable. So precedent transaction and comparable companies number. Just remember that precedent transaction analysis is used in merger and acquisition, and merger and acquisition, we have a tendency to overpay because of synergies and because of control. And comparable companies analysis, we are only comparing in between the companies of the same peers, same industry, same business models. So that way, precedence transaction numbers are higher than comparable companies numbers, and DCF numbers are actually variable, and it will DCF numbers will vary and based on scenarios. What are the what how much growth rate or the other rates you are assuming for the best case? Either you are being optimistic or conservative. So DCF is the DCF numbers are variable. So we cannot rank these three valuation methodologies from highest to lowest. So this was a trick question. All right, so I think this was clear. Let's move to next question. Question number three. The question number three is asking you about when would you not use a DCF, cash, discounted cash flow in valuation. A DCF valuation estimates the intrinsic value of the company by forecasting its future free cash flows and discounting them back to their present values using a discounted rate, which is usually weighted average cost of capital. However, the DCF only works well when future cash flows can be reasonably estimated and when the capital structure behaves normally, like debt and working capital have predictable rules. So we are able to predict the debt and working capital. So there are specific cases where DCF do not make sense and are not reliable. And what are those cases is when the company has unstable or unpredictable cash flows. So if a company has unstable, unpredictable, or no cash flows, then we cannot use DCF because DCF as it's in the name cash flows. If a DCF relies heavily on projecting future cash flows. If a company's cash flows are volatile, uncertain, or negative, then we will not be able to estimate a growth rate or any kind of rate. So if a company's cash flows are volatile, uncertain, or negative, then your DCF will be based on guesses rather than a realistic estimate. Examples are early stage startups. A startup is like an early stage company where no profit, negative cash flows, and unpredictable revenue growth is there. Their value depends more on future potential and market transaction than on current cash flows generation. So we cannot use a DCF in the case of a startup. Like, and the second case would be biotech firms. A biotech startup might spend millions of on R&D and have no revenue until a drug is approved, which could take years. The future cash flows are binary, either massive success or zero. So you will not use a DCF in cases of startups, tech startups, or biotechnology startup in healthcare. If you analyze any healthcare company, you will see that most of the major of the time their revenues are negative or the revenues are not the company's net income is negative. Pardon me, revenues are not negative, net income is negative. So what to use instead? If there is a startup, then we will use comparable company analysis, precedent transaction analysis, and venture capital methods for startups. So venture capital methods, we have not discussed about them. So we will discuss about those in the future readings. So because these numbers rely on market multiples and comparable deals and not on the forecasting of cash flow. So understand this thing. If there is no cash flow, we will not use DCF valuation methodology in those companies, calculating, valuing those companies. And it does make sense in cases of startups or when the debt and working capital serve as fundamentally different role. So this is the second point. Uh, we will not use DCF when debt and working capital serve as a fundamentally different role because debt is a source of capital used for used to finance company operations and investment, and working capital represents short-term and operational assets and liabilities like inventory, receivables, and payables. However, in some industries, especially financial institutions like bank and insurance companies, these assumptions break down. So we will not use DCF in those companies where debt is a source of capital. So if you are using debt as a source of capital, like in a bank, or if the working capital represents short-term operational assets and liabilities like inventory, receivables, and payables. So let me give you just an example, and let's talk about a bank. So bank borrows money, deposits it, and lends it out. This is the business's core business model of a bank. So bank will take your money and deposit it with them, and then it lends it out. So the debt is not just financing, it's the product. So in banking also we do not use DCF. Their working capital, loans, deposits, and investment is not just a support for operations, it is operations. So previously I discussed that in startups we do not use DCF. And the second point is that in banks also we do not use DCF because when we are practically doing a DCF, discounted cash flow, so we will also use debt as a source of capital in DCF, and working capital represents short-term operational assets and liabilities. So we will not be able to calculate we will be misinterpreting the meaning of debt here and the working capital requirements, because in some companies or in in some kind of business models, debt is actually not the financing, but it is actually the product. So for banks and investment banks, you will not use DCF because you cannot separate operating cash flow from financing cash flows like you can do for a manufacturing firm. And calculating free cash flow becomes meaningless. Banks do not invest in PPE or reinvest in traditional sense. So that's the main reason why we do not use DCF in cases of banks. So in banking, what should we use instead? Because we are talking about DCF and we have uh, introduced just this topic where we are discussing about banks. So in banks, we should use dividend discount models, or we can do a ratio analysis like price to earnings or price to book value multiples is often used in banks and insurers. So the in banking, we will use the dividend discount model and price to earnings or ratios like price to book value multiples. And just a quick summary to reminder, do not use a DCF when you cannot reasonably forecast the cash flow or when the cash flow, debt, and working capital do not behave normally in those companies. So you actually have to uh, remember these points, that DCF first is when the cash flow is not certain. The second point is the we are not able to calculate the free cash flow. And the components of free cash flow we will discuss we will discuss very shortly. I think in this valuation, in these valuation questions, we will be calculating free cash flow and we will be discussing free cash flow in detail. So let's read about the reading. So the explanation given by the question: you do not use DCF if the company has unstable or unpredictable cash flow, tech or biotech startups, or when debt and working capital serve as fundamentally different role. In case of a bank, for example, bank and financial institutions do not reinvest debt, and working capital is a huge part of balance sheets. So you won't use DCF for such companies. Let's move to question number three. Question number three is asking, uh, what are the other valuation methodologies that are there? So this question usually appears in investment banking, corporate finance, or private equity interviews. It is asking for valuation methods other than three standard ones: comparable company analysis, precedent transaction analysis, and discounted cash flow. So, what other valuation methodologies are there? And the answer to this question is other methodologies include, or other methods include, liquidity valuation, replacement value, leverage buyout, sum of the parts, merger and acquisition premium analysis, and future share price analysis. Let me just give you a quick explanation with every one of these every one of these new methods. So liquidity valuation is the method which assumes that the company stops operating and all its assets are now being sold off. Then you subtract the liabilities to determine what remains for equity investors like shareholders. And when this is liquidity valuation used, when a company is in distress or bankrupt, and we use this methodology to determine the minimum value of the business. And this is also common in restructuring or distress M&A. So if you are liquidating a company, shareholders would get roughly the minimum value. So this is how the, this is just a small explanation about a liquidation valuation method. Uh, So let's move to replacement value. So replacement value is based on company. Values a company based on how much it will cost to rebuild or replace asset today. So we are replacing the asset. So valuing a company based on the cost of replacing its assets. And when it is used for insurance purposes, so insurance companies actually use replacement value for the purpose, for insurance purposes, or asset heavy industries like manufacturing and energy, and sometimes used as a sanity check. If a company is valued below replacement cost, it might be undervalued. So that's pretty much it about replacement value. If you are to replace the asset, how much should be paid, the replacement cost of replacing its asset. LBO analysis, LBO is leverage buyout. So leverage in the sense means debt. So definition of this analysis is it is used primarily by private companies, private equity companies, or private equity firms. It estimates how much a private equity firm should could pay for a company to achieve a targeted internal rate of return. And when it is used is to set a floor valuation in a M&A deal. So LBO is used in a flow to set a floor valuation in an M&A deal to analyze the returns and leverage effects in private equity deals. So if a firm plans to buy a company for $500 million using $300 million in debt and $200 million of equity, and they plan to sell it in 5 years for $800 million after paying off debt, LBO, if the resulting IRR on the 200 million equity, so we are buying a company for eight for a $500 million, we are using $300 of debt and 200 millions of equity, and we are selling that company after 5 years for $800 million. So the internal rate of return, if the resulting internal rate of return on the 200 million equity investment is 25%, then 500 million is roughly the maximum they would pay today. So this is how the LBO analysis is done. The next method is sum of the part valuation. If the company has multiple divisions or businesses, each is valued separately using the most appropriate method. This means that if a company has different business lines, like they are into multiple products, like ITC example, so we will they to to value such a company, sum of the parts valuation is used. Diversified conglomerates or companies with different business units. And this method helps investors see whether the parts of the company might be worth more than together. So valuing each division of the company separately and adding them back together at the end. Merge M&A premium analysis. So the M&A premium analysis analyzes historical M&A transactions to see what premium buyers typically paid over target companies' stocks prices, usually over the unaffected share prices before the deal. And it's used in M&A advisory to justify the acquisition price or premium offered to the shareholder, or to estimate how much a buyer might pay above the market price. So M&A premium analysis. And the last valuation methodology is future share price analysis. The future share price analysis, it estimates what a company's stock price might be in future based on the projected earnings and expected PE multiples and the discounts that value back to the present value. And it's used when equity research or it's used for equity research or growth companies to understand potential investor return. And this was very much of a new concept other than the three methodologies, which was very common. So there are other valuation methods also: liquidity valuation, replacement value, LBO analysis, some of the parts, merger and acquisition premium analysis, future share price analysis. In summary, these valuation methodologies are supplementary tools. They help across cross-check or refine your understanding of the company's values, especially when standard methods like DCF or comparable analysis are less reliable and do not capture the unique circumstances. So, if we will give preference to the first three methods, comparable comps, transaction, and DCF, but if they are less reliable or do not capture the unique circumstances, then we will use these methodologies. And we can mix up all these methodologies to value a company also. All right, so let's move to question number 5. When would you use a liquidity valuation? And we have discussed about this is previously in the question number 4 only. The liquidation valuation is a method used to determine how much money a company's asset would generate if it were to forced to sell everything today. So usually quick and under distress conditions. It's basically answering the question that if we shut the company down and sold all its assets, how much cash would we get and who would get paid? And when it is used, uh, this is used most commonly in bankruptcy scenarios and is used to see whether equity shareholders will receive any capital after the company's debt have been paid off. It is often used to advise struggling businesses on whether it is better to sell off the assets separately or try to sell the entire company. So, bankruptcy scenarios, when a company cannot pay its debt, it may enter bankruptcy or liquidation. In such a case, liquidation valuation helps determine how much can a company recover from selling its assets like inventory, equipment, building, patents, etc., and who gets paid and how much based on the priority of reliance. And assessing equity valuation uh, is that investors and shareholders are last in the line during liquidation. So before they get anything, the company must pay, like secured creditors, banks and collateral, unsecured creditors, suppliers and bondholders, preferred shareholders, and at the last, equity common holders, if anything is left. So after paying all the debt, will there be any money left for the shareholder? So we are assessing equity valuation here. And the third is for decision making with for struggling businesses. So if a company is in trouble, or management or advisory might ask, should we sell the business as a whole, going concern, or sell it as in parts individually? So liquidation valuation compares the value of the whole company if sold using normal valuation methods like DCF or multiples. The value of the individually sold assets separately. If the liquidation is higher, then it may make sense to shut down and sell assets. Or if the liquidation is low, then they will sell the whole company as a whole. So, in summary, what you need to understand is that the purpose is to estimate what a company's asset would be worth if sold separately, often in bankruptcy and distress, and when to use it if a company is failing, insolvent, or considering whether it should liquidate or sell. And the main question to ask is, will shareholders get anything after paying off debt? When this is done, usually only creditors get paid and shareholders get little or nothing. And when to use is examples are advised. It's advised advising on bankruptcy, restructuring, or dis, business closures decisions. So that's when the liquidity valuation is used. Uh, these questions, the valuation questions are very detailed questions. So I would suggest you to revisit this presentation again and read all the explanations and listen to the explanation with an open mind. So let's move to question number 6. When would you use the sum of the parts valuation? So sum of the parts valuation, we have discussed previously that when a company has multiple divisions or business units, and that and those are unrelated or very different from each other, then we will be using sum of the parts value. Instead of valuing an entire company as a whole business, we will use sum of the parts value and separately using the valuation methods that make sense for each of them. And then we will add up the whole valuation from different methods to get the company's total value. The concept of sum of the parts value is that valuation method used when a company operates in diverse industries or business segments that should not share the same valuation multiple. So each company is treated like a separate mini company. You value each part individually using the most appropriate valuation approach, and then you add them together to get the total sum of the parts. And why it is needed? Because different industries have different characteristics such as growth rate, profit margins, risk level, and typical valuation multiples like enterprise value to EBITDA and price to earnings ratio. So, if a company operates across unrelated industries, say energy and entertainment, it does not make sense to use an average valuation multiple for all the divisions. If I were to give you an example, I will give you an example of General Electrics. So General Electrics is actually into aviation, into healthcare, into energy and power, into financial services. So all these businesses are very different. So aviation is a cyclical but high margin. Healthcare is stable with steady demand. Energy is capital intensive. And financial services have completely different financial metrics. So we have discussed that we will not use DCF in financial services. So financial services actually have a very different metrics. So in that case, where a company has very diverse business model, different product lines, then we will use some of the parts valuation. All right. So I hope some of the parts valuation is clear. We will understand in detail when we will do a practical question or we'll build a practical model of some of the parts valuation. So let's move to question number 7. When do you use an LBO analysis as part of your valuation? And when you LBO analysis, we have discussed that leverage buyout is when a private equity firm buys a company using a large amount of borrowed money to finance the repurchase. Uh, The PE firm contribute a portion of equity, their own money, the rest comes from debt. The goal of the PE is to improve, the private equity firm is to improve the company's performance, pay down of the debt over time, and then sell the company later at a higher value, and generating a target return, usually 20 to 25 plus internal rate of return. And what is an LBO analysis? So LBO analysis is valuation method used to estimate how much a financial buyer like a private equity firm could afford to pay for a company given a target rate of return, assumptions about debt financing and the company's projected financial performance. And it essentially it works backwards. So if a PE firm want to earn a 25% IRR over 5 years, so how much it could pay today for the company? This is how it works, and it's backward. And when do you use a LBO analysis is when you are evaluating a potential leveraged buyout deal. If you are working with a PE firm, this is a primary valuation method you use to decide whether an investment makes sense as a part of broader valuation in investment banking. Even when the deal is not buyout, investment bankers often use an LBO analysis to see maximum price a PE firm could realistically pay. This also helps floor value in valuing ranges because PE firms need to achieve a high return, so they won't be overpaying for the company, meaning their bid is typically lower than what the strategic corporate buyer would pay. So this is something you need to know and you need to keep in mind. And why it sets a floor value. And now think of valuation methods as giving you a range of possible values. So if you think about DCF, so DCF is it's theoretical more. It's more theoretical and intrinsic. And the valuation, if we are doing a DCF, it depends on, it's variable and it depends on uh, how optimistic or conservative you are. If you think about the comparable companies analysis, so the typical buyer actually will take assertions from market and the valuation will be medium, somewhat around in between. If you talk about precedent transaction analysis, the precedent transaction analysis done by strategic buyer, and they have a tendency to overpay. And when you look at the LBO numbers, the price to earning the private equity buyers, they will actually set up a floor because LBO works backward. A strategic buyer, because they want synergies, they will have a tendency to pay more. And okay, let's read this explanation given in the question. Obviously, you use this whenever you are looking at the leverage buyout, but it is also used to establish how much a private equity firm could pay which is usually lower than what the companies will pay. It is often used as to set a floor on a possible valuation for a company you are looking at. So if you are valuing a company and the leverage buyout numbers, so below that, the that's the floor means that the valuation cannot go below that. Okay. So I think we have discussed LBO in detail now. So let's move to question number 8 and see what is it. So what are the most common multiples used in valuations? And this question is about the valuation multiples, financial ratios used to compare the value of different companies. And the multiples are the key part of relative valuation, where we value company by comparing it with its similar companies called peers using certain financial metric. What are valuation multiple? And uh, a multiple expresses how much investors are willing to pay for a certain financial metric, like revenue, profit, or book value. In other words, if what multiple is basically nothing but the company value and we divide it by financial metric. So the most common valuation multiples are enterprise value to revenue. It Enterprise value to revenue means that how much value the market places on each dollar of sale. So if you are doing a sale of $1, so how much is the market valuing based on the each dollar sale? And it is useful for companies with little or no profit, for startups. Enterprise value to EBITDA, it shows that how many times a company's operating cash flow, EBITDA, business is worth. And it's commonly used across many industries. Neutral to capital structure, useful in comparing companies with different debt levels. So this is useful and like I said, neutral to capital structure. It's neutral to capital structure. It's useful for comparing companies with different debt levels. Enterprise value to EBITDA. So it's similar to enterprise value to EBITDA, but includes depreciation and amortization also. So more accurate for companies with heavy fixed assets. This will be uh, a better metric than EV by EBITDA. Price to earnings. Price to earnings is uh, in how much an investor is willing to pay for each dollar cash of earnings. So earnings and price. So widely used for public companies with positive net income. So this is used for public earning companies with positive net income. If you talk about price to book value ratio, uh, it compares market value of company to its book value, accounting book value. The book value is an accounting term from, and it's useful for banks and financial institutions. So this is very useful in banks and financial institutions. So we have discussed the most common multiples in detail now. So let's move to question number 9. Okay, this is a big question. And what are some examples of industry specific multiples? Okay, sure. So let's go through this step by step. This question is all about industry specific valuation multiples, which are special metrics used to value companies in certain industries, because traditional multiples like EV to EBITDA or price to earnings may not be meaningful or comparable. We will unpack each part carefully and illustrate it with examples so what are the valuation multiples? If we discuss about what are the valuation multiples, so valuation multiples help investor compare companies based on a ratio of value, like EV to EBITDA. For example, price to earnings or EV to EBITDA. However, these standard multiples don't always work well across all industries. That's why analysts use industry specific multiples that better capture key drivers of value. So if you are into equity research or if you are into investment banking, so you will be working on different sectors and industries. So technology, energy, real estate, retail and airline, consumers, energy, REITs, and other sectors also. So this is industry specific. So we will be discussing about industry specific multiples in this question. So for technology companies, if you discuss about technology companies, enterprise value to unique visitors and ratios depend on business models also. So how and business models, the KPIs and the impact, key performance indicators, impact, and the revenue and the cost drivers of the company. So if you think about a technology company, so enterprise value to unique visitors and enterprise value to page views make sense. Why? Because many internet or early stage tech companies don't have significant profit or even revenue. So traditional metrics like price to earnings or enterprise value to EBITDA are meaningless there. So instead, what matters is users' engagement. Um, and instead, what matters is users' engagement and traffic, which eventually can be monetized. Second is retail to airline. If you talk about retail to an airline, the common multiple is EBITDA, enterprise value to EBITDA R. So earnings before interest, taxes, depreciation, amortization, and rental expense. And why? If you think about it, earning before, why do we add back rent? Because in these industries, some companies actually own their properties or planes, while other actually leases them. If you talk about airline industry, there is dry lease or wet lease. We will discuss about those concepts later on. Or if you want to quickly learn them, just Google these concepts. So dry run and dry lease and wet lease. So okay, so if you just need EBITDA R, EBITDA companies that lease would look worse because their rent expense lowers EBITDA and EBITDA R adjust. If EBITDA plus R, EBITDA R adjusts for that, allowing apples to apple comparison. And without adjusting, it will look the companies which leases the planes, it will the numbers will look bad. For energy and oil energy means oil and gas. So common multiples will be enterprise value to EBITDA X, enterprise value to daily production, and enterprise value to proven reserve quantities. And energy companies value comes mainly from their oil and gas reserves and production capacity, not just accounting profits. EBITDA X actually adds back exploration expenses to normalize companies that either capitalize or expense exploration differently. Enterprise value to daily production compares how much investors pay per barrel of daily production, and enterprise value to proven reserve compare how much investors pay per barrel of proven oil or gas reserve. So after this, let's talk about real estate investment trusts, which are REITs. So real estate, the common ratio multiples for real estate REITs are price to FFO per share, fund from operations, and price to AFFO means adjusted fund from operations. What is an FFO? If you talk about this, so fund from operations is net income plus depreciation plus amortization, and we subtract the gains on the sale of property. And here in real estate investment trust, depreciation in real estate is large and non-cash. That's why we add it back. But properties may actually appreciate also. So if you are holding a lot of properties, so this there is a depreciation amount which is in which and there's a large depreciation amount also. But properties also appreciate and gain on property sale are one time, so they are subtracted to get normalized cash flow measures. And AFFO is adjusted. So this means that future adjustment for maintenance of capital expenditure and other recurring costs gives a truer picture of recurring cash flow. And in summary, if you talk about technology industry, the common multiples will be enterprise value to unique visitors and enterprise to page views. And why it is used is that the revenue and profit may not exist yet. User base is the value driver here. In retail and airline businesses, enterprise value to EBITDA are where the rent component is actually added back because companies have a tendency to lease airplanes, and it adjusts for rent difference between owned and leased assets. In energy companies, exploration, enterprise value to EBITDA X, EBITDA exploration, enterprise value to daily production, and enterprise value to proven reserve quantities is used because value of oil and gas reserves and production, because it values oil and gas reserves and production also. And exploration accounting varies. Yeah. Uh, we will discuss about energy in detail, technology and retail industries in detail in next or in future, because these are just questions and a brief and I mean the detailed overview of all these industries is also important. So I will make sure to make detailed videos for all the industries along with their sub industries and the sectors in future. So okay, so let's talk about the last, the REITs industry also. For REITs, the prices and FFO shares is the common ratio, and price to AFFO per share is also a common multiple, because depreciation distorts earnings. So uh, because depreciation is claimed, so it's a non-cash expense, but also the properties appreciate in price. This is why when we are calculating for funds from operations, we will calculate it by net income. We will add net depreciation back to net income and amortization, and we will subtract this gain on sale of property, realized or unrealized. If it's realized, then we will subtract it. If it's unrealized, then we will put it in the OCI, other comprehensive income. So we have not discussed about other comprehensive income as of now. So I mean, the different accounting treatments, we will talk about them later on. So let's conclude this lecture here only. We will discuss question number 10 onwards in the next lecture. All right. Thank you. Thank you for attending.